Today, Monetary Policy Part 2. This is a super exciting lecture filled with thrilling stuff, but it's not really. It's going to seem a little dry, perhaps, but I actually think it's a good learning. As far as learning goes, I think we learned some interesting stuff here, and I think it'll help you. It's a lot of stuff that you might have seen in the topics or terms you may have seen in the news that I think this will shed a little more light on them. All right? So the first thing we're going to talk about is borrowing to meet reserve requirements. Here's what I mean. As discussed a few days ago, large banks have a 10% reserve requirement. So here we have our famous First National Bank and its famous initial balance sheet. $100 in deposits, $10 in reserves, $90 in loans. So notice it starts off hitting its 10% requirement. $10 in reserves divided by $100 in deposits, 10%. Well, suppose a customer comes in and requests $10 in cash. So one of my depositors walks in, says, I've got $5 in cash here. I'd like to take it. All right, first question. What is the bank's current reserve ratio after that $5 withdrawal? Good, the answer is C. Why is that? Well, our reserves went down 50%. So our reserves went from 10 down to 5. Our deposits went down 5%. They went from 100 down to 95. So essentially what happened was, because the bank doesn't keep many reserves on hand, one customer walking in and asking for $5 took away half the money in the vault. So now we only have $5 left in reserves. We have $95 in deposits. Notice our deposits did go down by $5. Why? Because that's now $5 that the customer can't ask me for again, right? They asked for their $5. I gave it to them. They left. That means I no longer owe that person $5. 5 over 95 is about 5%. So now the bank's in trouble. It is not meeting its 10% reserve requirement. How to get back in compliance? That's the question for the bank. So one option is the bank can reduce deposits and loans. So essentially, you think about it, you're like, oh, I only have $5 in reserves. That's not enough money to support this big bank that I have now. So what I need to do is shrink the bank up, shrink my balance sheet. So that means reduce my deposits. So I tell some of my customers, come get your money. And so if I think about it, I see, well, I have $5 in the vault, $5 in the vault, and a 10% reserve requirement means I need to get this number down to 50. Which means I have to go from 95 down to 50. So that means I'm reducing by 45. So we take 95, subtract 45 from there. Now the other thing, so that's the first thing we've done, so it takes us from 95 down to 50. However, when I tell customers to come get their money, I don't have it in the vault, I've got to get it from somewhere. The place I'm going to get it from is my loans. And so I'm going to take out $45 from my loans. So what that means is I'm going to take some of the money who I've loaned to, people I've loaned money to, and say, hey, I'm trying to get rid of my depositors. I got to give them money. You've got the money. Call back $45 in loans. So you have to also reduce loans, which means tell the depositors, give me back my money. So this is one option. And this gets us to that 10% requirement. Notice, so 5, 10% of 50, 50 in assets, 50 in liabilities. So we're good there. However, what we've just done is we've had to make huge changes to our bank operations because someone asked for $5. There's a better way to do this. The better option would be for me to just borrow the money and put it in reserve. So all I need $5 for tonight so that I hit my 10%, and hopefully someone tomorrow will come deposit $5, something like that. So next question. All right, I'm going to borrow. Approximately how much money will the bank have to borrow to ensure it meets that 10% reserve requirement? The answer here is B, which is $5. Let's look at that. Let's see what that's going to look like. What that's going to look like is, notice our reserves went from 5 to 10, and our debt went from 0 to 5, right? Before, we didn't have any specific, we didn't owe money to anyone other than our depositors. And so when you go out and borrow money, that is different than getting a deposit from a customer. This says I went out, found someone, said, hey, let me borrow $5. So now I owe someone $5, but I've taken that $5, put it in the vault, so now my reserves have gone from 5 to 10. Notice, when I borrow $5 and put it in reserves, well, now my reserve ratio is $10 in reserves divided by $95 in deposits, which is around 10%. It actually puts me slightly above that 10% minimum. Perfect. This is what I needed, right? The depositor came, took their $5 back, so I just went and borrowed $5 back. So now I have hit my requirements, and notice, and I have not had to, drastically reduce my loans and deposits to do so. So this is typically short-term lending. So this is not a long-term solution for a bank to just constantly be having to borrow money. What it is it's short-term, and it's often called overnight, because what that means is tonight something happened and someone borrowed $30,000 from me to buy a car. Or someone who had $30,000 in savings took the $30,000 out, used it to buy a car. Well, now my bank vault has less money than I expected. So what I need to do is I just need to borrow money from today and hope that one of my, millions of customers tomorrow will happen to have, gotten a present, gotten a gift from their grandma of $30,000 in cash or something and deposited that. And so when I'm doing this short-term borrowing, I can borrow from other banks or from the Fed. We're going to talk about both of these. These are two distinct options. They have different terminology. So I can borrow that $5 from another bank, or I can borrow it from the Fed. So the first thing I can do is borrowing from another bank, and that is going to be where we're going to learn about the federal funds rate. Banks with excess reserves can loan them to other banks. So Bank of America is $30,000 short tonight. One of the places it can get it from is from Wells Fargo. Maybe Wells Fargo has $30,000 in it more in its vault than it expected. So, and Bank of America needs excess reserves. They can borrow them from other banks. So notice that both banks are going to benefit from this. Wells Fargo has $30,000 sitting around that's not going to earn any interest overnight. Bank of America really needs to get $30,000 for overnight. So what happens is that Wells Fargo loans Bank of America the money overnight. Bank of America maybe gets a big deposit tomorrow and pays back the loan. Both of the banks are better off. Bank of America was able to hit its reserve requirement. Wells Fargo was able to earn a little bit of money in interest. Well, excess reserves are traded on the federal funds market. That's what the market is known as, where you see these excess reserves overnight lending. This allows banks with excess reserves to earn some interest on these reserves. The federal funds rate is the interest rate banks pay when loaning to each other. So this is sort of a good overview of what the federal funds rate is. That's one of those terms you may have heard and not really understood. It does perhaps seem a little counterintuitive because it is the federal funds rate and it's not actually being set by the Fed. Next, we will learn about the discount rate, which is which applies when we are borrowing from the Fed. So, federal funds rate is when we are borrowing from other banks. The discount rate is involved when we borrow from the Fed. The bank can borrow from the Fed to meet their reserve requirements. This is called using the discount window. So you go up to the window and ask for a discount when you're borrowing. The discount rate is the interest rate at which banks can borrow money directly from the Federal Reserve. The Fed can adjust the discount rate to encourage or discourage banks from borrowing. So this one, unlike the federal funds rate, there's suppliers and demanders of money. So Wells Fargo and Bank of America, and they choose a price. Here, the Fed is the seller here. The Fed can decide what they want the discount rate to be. So one thing the Fed can do is decrease the discount rate. They can choose to lower the rate. Well, this is an example of expansionary monetary policy. So with expansionary monetary policy, we are going to decrease the discount rate. So here we go. It was here, down to here. When we do that, that will encourage banks to borrow from the Fed. Bank demand slopes down, right? If the interest rate that they're paying is lower, so the discount rate is lower, that's going to encourage them to borrow more money. So demand slopes down, so they go from here down to here. So that increases the quantity of money. Banks now have more reserves, which means that banks are going to loan out more money. So when banks loan out more money, that leads to an increase in the money supply. So we want to loan out the money to buy a forklift. After we buy the forklift owner puts that money in the bank, money multiplier kicks in, loans someone money to invest in their restaurant, and so on. Well, we have all this extra money supply out there, and we've decreased the equilibrium interest rate, just like how when you'd be, anytime you have a market, you increase the supply a bunch, we expect that to decrease price. Well, once the equilibrium interest rate goes down, then it becomes worth it to buy that third forklift. That increased investment increases GDP. So again, it's expansionary because it increases aggregate demand, increases GDP. Okay. I know there's a lot to write here, and there's also the next slide is going to be all of this in reverse. So contractionary, I can go back during the next top hat or at the end of class if anyone has questions. Okay, so let's talk about increasing the discount rate, which is an example of contractionary monetary policy. So with contractionary monetary policy, we increase the discount rate and discourage banks from borrowing. So that means banks are going to have fewer reserves. They're going to loan out less money. So the money supply decreases. So our money supply decreases. So essentially, if the Fed doesn't want there to be so much money out there, they say one of the tools they have is they can just say, fine, if you want to borrow money from us, you have to pay more. That will make banks borrow less from us, so it'll decrease the money supply. When we decrease the money supply, that serves to increase the equilibrium interest rate. So when we increase the equilibrium interest rate because now there's less money available. So if you want to borrow money, we're going to bid up the price of borrowing. And what happens when the interest rate is high? Don't buy that third forklift, decrease investment, decrease GDP. So now what we've done, we've sort of learned some definitions and seen a couple of graphs. Now what I want to do is sort of maybe get a little more descriptive and help you. I think I'll have an example from 2007 about one of these. And so hopefully the first part might have been a little dry, and this will sort of shed some light and actually give us some information on how this stuff applies in the real world. So the first is the federal funds rate. When you hear about the Fed raising or lowering rates, this is what they're talking about. So this is what they're talking about, the rate that banks use when they lend to each other. Now, it's important to note, the federal funds rate, like I said, is not dictated by the Fed. The banks are free to lend at whatever rates they choose. So when the bank talks about raising or lowering rates, the term they'll use is they have a target interest rate. So this is what they want banks to charge each other. The Fed then uses monetary policy to adjust the money supply and make the federal funds rate match the target. So here we have an example of how that's going to work. So we start off with money demand, looks like this. And so the Fed can adjust money supply. We've talked about how it does that. It usually uses open market operations. And the Fed can, when the Fed adjusts the money supply, that is movement along this money demand curve. And as a result, the Fed can adjust the money supply and get the interest rate to where they want it to be. The discount rate is typically set above the federal funds rate to encourage banks to rely on each other rather than on the Fed for overnight borrowing. So remember, discount rate is what you pay when you borrow from the Fed. And the Fed would prefer that these banks kind of work it out amongst themselves for the most part. And to do that, what they say is, we'd rather you borrow from each other. And if you want to borrow from us, you're going to have to pay a higher interest rate. One notable exception happened in 2007. So in 2007, there was panic over whether large investment banks had enough assets to cover their debts. And so you think about this as end of the day, Goldman Sachs says to Lehman Brothers, hey, I need to borrow some money. I need to borrow $20 billion. Can you loan me $20 billion? And Lehman Brothers says, oops, I also needed to borrow $20 billion. I was hoping you could lend it to me. Well, the Fed stepped in, reduced their discount rate in order to encourage, to provide the banks with some liquidity or cash. And so here, there's an example of when the Fed did use the discount rate, actually lowered the rate for a specific reason to help these banks stay in business. Right? Next, we're going to learn about targeting the federal funds rate. So how exactly does that work? Well, like we said, the Fed does not explicitly dictate the federal funds rate. Banks are free to loan to each other at any rate that they choose. The Fed uses open market operations to ensure that the federal funds rate hits the target. So again, this is what we just talked about, how the Fed doesn't mandate the federal funds rate. Instead, what they do is they adjust the money supply, typically using open market operations to hit that target. Next, as the federal funds rate decreases, reserves increase. So this is just saying that the demand for federal funds slopes down. Right, so if the federal funds rate is low, so if Bank of America can borrow from Wells Fargo inexpensively, they're going to tend to borrow more money. That way they'll borrow more, they'll have it in reserves, and they can loan it out. So when the federal funds rate decreases, reserves increase because the opportunity cost of reserves is lower. It costs you less to keep that money in your vault. Suppose the Fed is targeting a Fed funds rate of 3%. So the Fed had their meeting, they came out and they announced our target interest rate for the next quarter is 3%. And the Fed used, talked to their economists and looked at some modelers, and they estimated that the demand for federal funds looks like this. Well, this happens when there are, this 3% rate happens when there are $60 in reserves. So the way we see that is we just take a look at this demand curve here. This right here is the demand for federal funds. And we say, all right, at what quantity of reserves will there be a price of 3%? Right? So it turns out that a price of 3% corresponds with $60 in reserves. So if the Fed funds rate is 3%, there will be a demand for $60 in reserves. Well, what that means is the Fed will use open market operations, so buying and selling T-bills, treasury bills, to keep reserves at $60, because this demand tells them, all right, we need to make sure to keep reserves at $60. We need to make sure there's $60 in reserves out there, because if so, that'll hold the Fed funds rate at 3%. What happens if demand shifts? For example, banks are worried about a future recession and are holding more cash and lending less. That means banks have to borrow less, shifting demand to the left. So let's see what that looks like. That's going to look like that. So demand was the gray, shifts to the blue, because now I'm not really that interested in borrowing from the Fed. I'm not really loaning much money. I'm just holding on to what I have. So again, and this is just banks' preferences changed. Well, the Fed wants to keep the interest rate at 3%. How do we expect the Fed to respond using open market operations? So how do we remember so right now, this is the quantity of reserves, so is 60. What the Fed wants to get us to is somewhere over here, where the new demand curve intersects with a Fed funds rate of 3%. So how is the Fed going to do this? So the answer is A. The Fed is going to sell treasuries to get cash out of the market. So according to our new demand curve, the banks will demand $40 in reserves if the Fed funds rate is 3%. Blue demand curve says Fed funds rate of 3% corresponds with $40 in reserves. Well, right now there's $60 in reserves out there. So that's $20 more kind of floating around with the banks than I want. So in order to keep the rate at 3%, the Fed is going to need to adjust the supply of reserves from $60 down to $40. So how do we do that? Well, using open market operations. What's that going to mean? I'll kind of do the version of that flow chart we saw before, where we have the Fed's going to be on the left, bank on the right. So what we need to have happen is we need to get $20 from the banks to the Fed. We need to get $20 out of the market. Well, in order to do that, the banks aren't just going to give the Fed $20, right? The Fed's got to give them something in return. Using open market operations, that's going to be $20 in treasuries. So what that means is the Fed gave the bank treasuries, the bank gave the Fed $20, so the Fed sold $20 in treasury bonds to get cash from the banks and out of the market. Okay, the next thing we're going to do is something that I said I like to do, which is towards the end of class, do a couple of review questions. So questions from stuff we did a few days ago that will help you sort of refresh your memory and give you a sense of the kind of questions you'll see on an exam. So first one, if the Fed wants to prevent inflation, it should blank the money supply. This will cause GDP to blank. Good, the answer here is A, decrease. Now let's walk through why. We can trace what's going on when we reduce the supply of money. The first thing happens is when we reduce the amount of money available, that is going to push up the interest rate. Because as we've discussed, whenever you make there be less of something, that's going to serve to increase the price. There's not as much money around, so if you really want to carry cash, you're going to have to pay more for it in the form of a higher interest rate. So money supply decreases and interest rates increase. Okay, next we look at the investment demand curve to see how an increase in interest rates affects investment. And when the interest rate goes up, that leads to a decrease in the quantity of investment demanded. Because now we're going to buy two forklifts instead of 3, because now we're having to borrow so much to pay for that third forklift, the extra profit isn't worth it. So investment decreases. Well, investment is a component of aggregate demand. So aggregate demand decreases. Here it's going to shift from 81 to 83. Now when that happens, we're going to get our GDP decreasing and the price level decreasing. Think about it, we went from 0.1 to 0.2. So we have lower GDP and lower prices.